Hello everyone, I hope you're all doing well. Today I wanted to go into a bit of research into the vertical farming stocks market because I'm hearing a massive buzz about it. Everyone's saying it's going to be the next Tesla, it's going to boom. And so I wanted to have a look at the sort of numbers myself and have a look to see whether any of this was actually true, what my fair values would be for them. And I've done a little bit of a thread on some of it already, so I just wanted to catch everyone up by going through this. So AppHarvest, GRWG, Hydrofarm and VFF were the four that I looked into a tiny bit, and then I did a bit of a thread in the quote tweets. So for each of these, they weren't currently profitable, so I was focusing on the PS ratio based on this image, a really good thread put out by Brian Ferraldi, and going through that thread, he uses this image where it says the best ratios to use at different stages of a stock's life cycle. And as all of these aren't currently profitable, they haven't broken even yet, I've been using the price to sales ratio for my research into these. So for all of them, they did all have quite high revenue growth forecasts, but all except Hydrofarm had very high share dilution. So I think that sort of reduced the attractiveness. It offset against the revenue and it made it not as attractive. Whereas you can see Hydrofarm here, although there's a small increase from 2019, it's nothing in comparison to AppHarvest, basically doubled on the year. Grow generation, you can see it's just gone from under 15 million to about 60 million in 5 years, just doubling twice. And so that really offsets any revenue that you'd hope to, if the company's growing revenue at crazy rates, but they're also releasing shares, then you're not actually seeing much of an increase in the value of your own share. So that put me off of this one a bit. And similarly with Village Farms, you can see it's really boomed in terms of how many shares they've given away, and it just puts me off getting into them really. Going into a bit more detail, obviously there's a high risk involved with all of these stocks because they're not even currently profitable yet. They're all very much at the start up, they have low caps, but with these type of stocks there is room for a potential higher return, and that is what you're looking for, is risk versus reward. But as Hydrofarm doesn't have the really high share dilution, I thought that looks like the safest bet, and it's probably the one I'm most confident in to return well, but it's not the one I think has the highest potential, because AppHarvest's estimated growth rates are absolutely off the scale. You can see here in 2021 they had 9 million revenue, and in 2025 they're expecting 153.10 based on this analyst estimates. And I mean, if it increased at that rate, you're looking at an absolutely absurd increase in value. So these are the things I want to go into in a bit more detail. I've made a sheet and I've pulled over all the information, other than I've just pulled over the information relevant to price to sales. I haven't brought over all the PE ratios and all the operating cash flow ratios, because for this I just wanted to look at the revenue. So this is Hydrofarm. I've put in some of the information already, and as you can see, common shares outstanding is 45.09. They haven't increased it much in 2022, so hopefully the share dilution is not going to continue to increase at least this rate it did from 2022 to 2021, but we can't be certain. I've accounted for a 10% share dilution because they don't seem like they're really aggressively releasing shares, and they did cut them by half in 2018 and 2019. So I think a 10% share dilution costs in for them without being really over the top on how much we think they're going to release. Additionally, with the price over sales ratio, I've gone for 2. All the things in yellow fill, by the way, are the things that I can change to change what my fair value for the company would be. I've gone for 2. It might be a bit on the high side, so I'll lower it a bit, but you can see it was 5.15 in 2020, 2.54 in 2021, and it's as low as 0.32 right now, which is really low based on historic price to sales. You can see there. So I would be comfortable definitely upping it. Even if it was to 1, you'd still see a 61% difference in the fair value here at 5.32 compared to the current price at 3.3. So that is obviously a massive difference in those values. I think with the discount rate, I've gone for 12%. That means that if we wanted to make a 12% return each year based on the numbers we put in here, this is the expected fair value in 2027, and so it goes back by 12% each year, and then that's where we'd want to see that 12% return. For the margin of safety, I have gone for 10%. Although there's high risk involved, you could potentially up it to 20. Still see a great return even with the low PS ratio, and I've accounted for other things. Although margin of safety is 20%, I've taken a margin of safety into my estimates. So where there's revenue growth rate, I've gone 17.5. You can see for Hydrofarm on their earnings, their expected growth, they're expecting to hit 822 million in 2025. That would be much higher than 17.5%. The 2025, I've got 548 revenue. But what is important to take note of, and I've mentioned it before, is the revenue growth rate, or not specifically the revenue growth rate, but just the analyst growth rate predictions on average are 100% higher than the actual growth rate that the company does. So I think I looked into a study, and on all analyst growth rate predictions of 12%, when they predicted that much growth, they then watched those stocks, and on average each of those grew by 6%. So the average revenue growth rate prediction, or not revenue, but the average growth rate prediction is on average 100% higher than what the actual growth rate is. And so I've gone for 17.5 because 35%, that puts you at around that 820 million mark. So I can lower it a tiny bit more, 17, and because 34 would put you just under that mark. So I think 17, I think that's a fair revenue growth rate. I think that's accounting for things, and you see even with all of these things accounted for, a 20% margin of safety, 10% share dilution, a low PS ratio comparatively to the previous 2 years, because you can see it was 5.15, then it was 2.5. Even with all of these low estimates and conservative estimates, there's still quite a large upside here, and I do think Hydrofarm is one that I'd be most confident in seeing a good return on. But I want to show you AppHarvest, because the potential return on AppHarvest is absolutely crazy. So let's get into that quickly now. So first of all, I'm going to update the symbol to AppPH. That's going to change the price here. The common shares outstanding, not 45.09. They haven't increased too much in 2022. As you can see, it was 101.14 in 2021. It's at 105.89 right now. So that makes me a little bit, it calms me a little bit compared to this jump from 44.46 to 101.14. Obviously, share dilution at that rate would absolutely kill any potential revenue and return that you hoping to make, because the revenue's not going to be able to keep up with share releases that high. But they haven't increased it too much from 2021 to 2022. But I would want to account for a higher share dilution than 10%. If I go 25%, that's a really high amount, but I think you need to account for these things in case they are, in case they happen, because there is a potential risk that could happen, so it's good to account for. Additionally, the PS ratio is going to be nowhere near 1. Their price over sales completely different. You can see here it was 41 in 2021 and currently it's 24. So I'd want to lower it a bit because it does look like it's coming down, but obviously there's not a large amount of trend to go with. I'm going to put 15 in for now as our price over sales ratio, and obviously we need to change all this information, so don't look too much at this fair value yet. The one thing I do want to bring your attention to though is this price to book ratio. This is a really good sign, and this is what makes me a little bit more comfortable investing into what I feel is a high risk company like AppHarvest, because their price to book ratio is currently under 1, and that means if they were to liquidate the company, it would be worth more than what the current shares are worth. So I do think that this means there's less risk involved compared to something with a much higher book ratio. I mean, you see it's 28.10 in 2020, and if I just show you the graph quickly, you can see, I mean, if it was up here potentially in 2020, then obviously it might be December, I'm not sure when it takes the date from, but if it was from the December, then you can understand why it was high, because it's at 18.4, it's shot down all the way to 3 right now, but you can see there's a strong buy recommendation from the analysts. So if we just go back to our sheet, I think that 20% margin of safety is fine. We're looking for that 12% return each year still. Share dilution, we're looking at 25%. But this revenue growth rate and revenue, this is where things are really going to change. So if we go back to the financials, you see on the earnings, their revenue growth rate is absolutely off the scales from 20.6 to 153.10. So let's put that information in, 20.6 for 2022. And then the revenue growth rate is going to be way higher than 17%, at least for what they're predicting. They're predicting to get to 153. I think that's around 95%, which is obviously very, very ambitious, and I'm not going to use 95%. But imagine for a second that the analysts are right, then you're looking at a 288% return on the fair value. So that's is one of those things. If it does happen, fantastic, but I'm not going to account for it happening. I'm going to do what I did before. So I'm going to change that revenue growth rate to about half the amount, because I think that's a bit more realistic, and you want to account for that analyst prediction on average being 100% too high. I think 95% is absolutely off the charts. So I want to put 47.5 in here, and you can see that does actually bring the fair value just under, even growing at this 47.5%. But this is because we've accounted for so much. We've got a 20% margin of safety, 25% share dilution, and a PS ratio, of 15, which is lower than it's traded at in any year. So we could easily move those up. These are really, really conservative estimates. If we bring that margin of safety down to just 10%, you're looking at 8% difference. And based on the share dilution, they've only increased it by a small amount in 2021 to 2022 so far. We're at 105.89. You can see we'd be looking at 132 next year, so that's still a massive increase. So we could easily bring that down maybe to 15, and then you're looking at a 64.2% return. So it very much depends on what you do with these numbers, and I think the potential upside, I think this 25%, and with the 15 PS ratio and a 20% margin of safety, for that to fall just under at only 3%, this is very much, I'm not going to say worst case scenario because it's definitely not, but these are very, very conservative estimates compared to what it could be. Say we used a 10% margin of safety. If they don't release that many shares, because they haven't released a lot in 2022, if their share dilution is only 10% and their growth rate is close to what the analysts say at 90%. And I'm going to be honest, this is more of a gamble than if you were trading in large stocks, then like in large cap stocks, then you haven't got the same risk involved that you have with these, but you don't have the same reward either. You're looking at potential reward if the analyst revenue growth rate is accurate of 620%. I mean, that's just in what the fair value would be now. So realistically, I don't think that we're going to see values of this, but there is always the potential. I personally would go with estimates. I think with these estimates, there's still a good upside here, fair value of 3.95, and this is more, I think you're accounting for a lot more in these sort of estimates, and I think that makes the fair value 3.95. I think while it stays below that, I might be looking to pick some up. For me at the moment, most of my portfolio is in low risk stocks that are steadily increasing, and so adding a small part of my portfolio in a small cap stock with high risk like this isn't going to be detrimental to my overall portfolio. So I think I might look to add some of these vertical farming stocks, maybe £50 of each, because it does have that potential to turn into something worth hundreds and hundreds. So that's what I think at the moment. These are the two I'd be most interested in looking into. Let me know if there's any other vertical farming stocks that you're interested in, and if you did enjoy this video, leave it a like, and thank you for watching.